So section 3 is computing the costs of credit. So we're going to explain the various costs and the method used for calculating interest. So we talked about that yesterday. Banks and credit card companies, they all charge you, right? You get these interest charges or finance charges, as we are going to see about on the next slide. And we're going to talk about how they can do that. So a finance charge is the total dollar amount of all the interest and fees you pay for the use of credit. So finance charge is the interest and the fees for the use of credit, right? So these companies, banks, credit card companies, they loan you the money. They give you this credit and then, but it's not for free usually. And so you pay for it. So the finance charge increases the cost of the items you purchase on the credit, which again, we talked about that yesterday. So when you buy something on credit, you kind of have to ask yourself, is it really worth it? Because I'm really going to be paying this much money in the long run. But that price you pay is the privilege of using someone else's money to buy goods and services right now. You don't have the money right now, so you use credit and you pay for it. Thank you, Forrest. So this is an example of a partial credit card statement. Thank you. And you can see that there is a section that says finance charge schedule. It might be labeled a little bit differently, but you can see for cash advances here, the annual rate is 15.97%, and it's kind of broken down. Up above the top part, the summary says the previous balance, the payments, no cash advances, purchases and adjustments, finance charges. Hey. And then the new balance. And notice that their balance at the end of the month is $1,200, but at the bottom you can see that the minimum payment is only $15. So just real quick, $1,200 divided by 15, that would take 80 months, which is almost 7 years, if nothing else was charged and no other finance was, no other interest was charged on it all, and you didn't use it anymore. It would take almost 7 years to pay that off if you were only making the minimum payment. Again, in a perfect world where nothing else goes on it. So the minimum payment is the amount you are required to pay each month on a credit card. And it changes month to month, depending on your balance. So if only minimum payments are made, it takes longer to pay it off, as I just kind of went over on that last one, and it's going to cost you more. So when I just divided the 1,200 by 15 on that last slide, that wasn't even accounting for any interest that would be added over time. I don't know if it comes up in the next chapter. I think it does, but just so you know, while I'm talking about it, credit cards now have to, when you get your statement, they have to say on there how long it would take to pay it off if you only made the minimum balance and how much it would cost you. I think it comes up, but it's worth repeating more than once. So credit card statements must say how much it would cost you in the long run and how long it takes to make a minimum payment, as well as show you another plan, like, but if you really paid $50 a month instead of the minimum payment, it would take this long. So a fixed interest rate is, sorry, you can't really read all that, an interest rate that is set and does not change from month to month. Just like we talked about fixed expenses, fixed meaning it doesn't change. So a variable interest rate is an interest rate that goes up and down with inflation and other economic conditions. So the downside is if interest rate goes up, your payments will go up and you might not be able to afford them with the variable interest rate. So that happened to a lot of people in 2008 when we had a big crisis. People couldn't pay things and then our economy went down, but the interest rate went up, people's payments went up, they couldn't keep up. But again, the other side of that is if it goes down, your payments will go down as well. So fees are another cost of credit. So annual fees, I know I mentioned it yesterday. Some credit cards have annual fees, not all of them, but some of them do. And it's like $49 a month, $99 a month. They might have different fees. Some of them have transaction fees, especially if you do a balance transfer, which is moving a balance from one credit card account to another. And you might be wondering like, well, why would I do that? I'm going to pay a fee to move my credit card from this one to another one. Well, it can be beneficial. So for example, say you have a credit card with, you have two different credit cards. One of them has maybe $5,000 on it and the other one doesn't have anything. Well, the other one might offer you like, to transfer it to this one that has no balance on it, $0. If you transfer the $5,000 from the other one, so you might pay a fee, which typically is a percentage or a minimum. But say it's 1% of $5,000. So you're looking at $50, but it might have no interest for a year, where the account it might be sitting on, the credit card it's sitting on right now might have a 20% interest rate. So that $50 for the balance transfer could be less than you would pay in interest on the other credit card. But again, it has a fee with it. And it can be a good idea, but it can also just cause you to spend more money. So again, as I was saying, credit is great if you use it wisely. Cash advance fees. So money borrowed against your credit card. Most credit cards have a cash advance limit. So say your credit card limit is $1,000, your cash advance limit might only be $200. So you can go to an ATM with your credit card and take that money out. But again, you're going to pay a fee and the interest rate is going to be higher. I don't recommend doing that. If you need to spend $200 and you don't have the cash and you need it, use your credit card when that option is available. And penalty fees, which is a fee charged for violating a term of the credit agreement. So a late fee, or if you go over your limit, you're going to pay fees for those things. So consequences of late payments and going over your credit limit. So one, you will be charged a fee for both late payments and for going over your limit. So if you do the same thing in both months, you're going to get both of those fees at the same time. Also, the bank can increase your interest rate on new purchases made on that credit card. So some of the terms on that card might be that they can increase your rate if you don't stick to the conditions, which the conditions are you make your payments on time. No. But how the new is asterisk there, if you already have a balance on your credit card, that stays at the old interest rate. So you will be charged two different interest rates for the stuff that's on there. And another consequence is your credit score will go down. So you may not be able to get a loan, rent an apartment, get the job you want, get a cell phone contract. So a lot of places look at your credit score. When you get a loan, yes, they look at your credit score. Some housing, they're going to look at your credit score. So if you want an apartment and you're wondering, why do they look at your credit score? Because it shows if you're reliable, if you pay your bills on time. That's part of your credit score. Some jobs will look at your credit score, especially depending on what industry you're in. If you're in any kind of financial industry, yes, they're going to look at your credit score because they want to know that you are financially responsible. Cell phone contracts, same idea. PG&E will look at your credit score, or you can pay a deposit. So some places give you the option, but that's a consequence. As well as when your credit score goes down, you pay higher interest rates on your loans and insurance premiums. So it kind of hurts you all around. We're going to talk more about credit scores soon. Maybe next week, maybe after spring break.
I want a cookie.
So how is interest computed on credit? Give me a spit rag. So the grace period is the amount of time you have to pay your current credit card balance in full to avoid paying interest. So you have a grace period. Thank you. And again, that's, hey, you owe $1,000. If you pay it all by this time, you're not going to pay any interest. Billing cycle is the period of time between credit card bills. And then there are 3 methods to calculate interest: the adjusted balance method, the previous balance method, and the average daily balance method. And we're going to look at all 3 of these on the next few slides.
Why? And
What?
where did I put my phone?
I don't know.
On the counter?
Probably. So first we're going to look at is the adjusted balance method. So the interest is calculated based on the amount owed after you have paid your bill each month. So this is the adjusted balance method. On the next slide, I'll kind of talk about the math to it. But again, I'll give you time to write this definition down. Interest is calculated based on the amount owed after you've paid your bill each month. So that's the same picture. The previous balance was $500. You spent $30, then $50, and another $80. So you spent a total of $160 this month on your credit card. You made a payment of $100. So your adjusted balance is $560. They added in your charges and took away the payment you made. So $560. That's what they're computing the interest off of. So 18% yearly. So $560 times the 18%, which we know we would do 0.18, and then times 30 over 360. So they're using the equation interest equals principal times rate times time. And for the time, they're using a 30-day billing cycle out of a 360-day year. That's kind of going to be the standard. Is 1/12 like that, 1 month? Yes, we know a year is really 365 days or leap year. But for simplicity, it'll often be over 360. It just makes the math work out a little bit better. So in this example, the interest was $8.40. So that gets added to the new balance. Oops, the previous balance method. The interest is calculated based on the outstanding balance at the end of the previous billing cycle. So this is the same example. You had $500 from the last month. Previous balance method, they calculate your interest right then. So 18% times $500 times 3 out of 360. So the interest here is $7.50. You still bought stuff worth $160. You still made a $100 payment. So here, interest is $7.50. In this case, it's a little bit less than it was in the last example. And that's not always the case. The last example could have been less if the payment was more. So it does vary. They all have their pros and cons. So again, charges and payments in the billing cycle are not included. And the new balance is a previous balance plus interest and charges minus any payments. And the last one is the average daily balance method, which is an adjusted balance is computed for each day of the month. And this is used by most creditors. Not all of them, but this is going to be the most common. And honestly, for me, I don't even know what my credit card companies use because They are fairly similar, and you don't really get a say. Yes, if you're shopping around for credit cards and you feel strongly about one of these methods over the other, that might be something to look into. But for me, it's not a make or break it factor. It doesn't change much. That's my opinion on it. So the adjusted balances for all days are added and then divided by the number of days in the billing cycle. So average, we know to find the average, you add everything up and divide. So this example here, it's the same thing. The previous balance that came over was $50. You can see they didn't charge anything day 1 or 2. Day 3 was $30. Day 4 was $50. Day 5 was $80. So in the far right column, you can see the new balance, right? They're adding every day. Day 25 is when you make your payment of $100. So your balance goes down to $560 then, and you don't use it again. So at the end of the month, your balance is $560 before interest. So the average daily balance, they add 500, 500, 530, 580, 660. They add a bunch more 660s, right? For day 6 through day 24. Then they add the 560 for all of those days. They add it 6 times. Add all that up, divide by 30. That's the average. So you can see the average daily balance is 563.67. That was never the balance. Never one day was the balance 563.67. But that is the average. And so they use that. They do 563.67 times the 18% times 1/12. So the interest here, which happens to be a little bit higher, is $8.46. So that gets added to the $560 that was the ending balance, not to the average daily balance. So in the first example, the interest was $8.40. The second example, it was, oh, no, don't pull that. Let me go back to it, $7.50, and this is $8.46. So a little bit higher, which is probably why most credit card companies use it. But again, it's not always going to be the highest, depending on kind of when you make your payment. Had they paid the $100 earlier in the month, then it wouldn't be the case, right? Because they would have a lower average. But that is it for our slideshow. So next week, we will, I think, do some of these math examples so you can kind of practice the different methods. I haven't decided if we're going to do those. And we'll kind of finish up chapter 7 next week. We'll do vocab. We're going to do some more math with it for sure. You'll have your test because we're going to end the chapter and we'll take our test before we go to spring break. Tomorrow, you are turning in all of your book work and your notes for this chapter. That is due by 3 p.m. tomorrow, as well as the assignment from Tuesday. It is its own assignment in Google Classroom, so that gets turned in separately. A handful of you already did, and some of you maybe, remember that was breaking a bad financial habit. Some of you may already be kind of trying to follow through with your plan to see how it's going for you. Also look for some attendance question or survey of some sort tomorrow to answer by noon for your attendance. Do we have any questions?